Hello friends, today I have come with a new concept in public issue of shares by companies, and that is anchor investor or qualified institutional buyers. Well friends, when a company wants to make public issue of shares, it has to find out the price at which the shares are to be offered to the people. Every share has a face value, but the shares are not offered at face value of the shares. If the company has good profits, good future, good management, the company may decide to offer the shares to the public at a premium. That is, at a price which is more than the face value. Or if a company is not having a good future, it's not well known, and if the management is doubtful whether the investors will subscribe to the shares or not, the company may offer the shares at a price which is less than the face value. That is called as shares offered at discount. And it will act as an incentive to the shareholder, to the investors, to invest in the shares. If the company offers the shares at a price which is much more, then there is a possibility that investors may not subscribe to the shares fully. And if the company offers the shares at a price less than the market expectations, then the company will be a loser, though the share issue may be subscribed, but the amount that is collected may be less. In order to avoid this, the company tries to make an assessment of the fair price of the shares to be offered to the public. How this fair price can be found out? How the response of the probable investors may be assessed? One of the ways for that is approaching the anchor investors or qualified institutional buyers. These are the institutional buyers. They are the institutes. Maybe the banks, maybe the insurance companies, maybe mutual funds, maybe foreign institutional investors. So they are institutions. They are registered with SEBI. They have ample financial strength, ample investable funds, and they have expertise also in financial analysis and forecasting. These institutional investors will analyze the issue of the shares, will analyze the working and future of the company, and will decide whether to invest in this issue or not. And if they decide to invest, what should be the price to be paid for the shares? There is a process of negotiations between the management of the company offering the shares and the qualified institutional investors. After the negotiations and analysis, the qualified institutional investors may offer the price at which they are willing to buy the shares and the number of shares that they are interested in buying. If the company and qualified institutional buyers agree, then the deal is finalized and the qualified institutional investors get the benefit of confirmed allotment at the agreed price. So they take the risk. They accept the price beforehand, before the responses of the market. They commit for a number of shares. This is the risk that they take. As against this, they get the benefit of confirmed allotment. Now, once this deal is done, the company then decides the price band. That is the lower and higher price to the people for subscription of the shares. the investors will get a clear idea as to whether this price band is correct or not, because they have the price of qualified institutional buyers. So they can very easily compare the price at which these qualified institutional buyers have agreed to buy the shares and the price offered to the general public. So they get one base for making a decision of price payment. Second, as they don't have the expertise to analyze the company's performance and forecast the company's financials, well, they get the idea from qualified institutional buyers' decision. These are the two main benefits that the retail investors get from qualified institutional buyers. SEBI has put up one restriction on these qualified institutional buyers of not selling these shares purchased by them on the stock exchange once the listing is made for a particular period of time. So once the issue is over and the shares are listed on the stock exchange, for a certain period of time, these QIBs are not allowed to sell their shares. With this restriction, well, there is no flow of shares in the market immediately after listing, and the price of the share may remain stable. Therefore, that is called as anchor investor. This is one more benefit to the retail investors. As I said, for companies also it is beneficial because they can get the idea of the price band that they can fix for issuing the shares to the general public in the market. So this type of an arrangement is beneficial to the retail investors, to the company, as well as to the anchor investors. And hence, this has become a popular thing. The purpose of these anchor investors is not to provide the capital to the company for a long period of time. Their intention is not to be a partner in the company's performance in future. Similarly, they are not at all interested in managing the company or becoming a part of the management of the company. Their intention is very simple. They invest in this issue at the agreed price which they negotiate in a certain number, which is assured number of shares, and they keep their investment blocked for the period which the SEBI has specified. So their intention is only investment, earning profit on investment, nothing else. So this is how this anchor investor functions. And I think this has helped a lot to the retail investors, to the companies, and to anchor investors also. This is all about anchor investors or qualified institutional buyers. Goodbye. Let us meet in the next video with some another concept. Till then, goodbye.